Welcome to Talk Tickers. Today we're breaking down the Zymeworks Q3 2025 earnings call. And let me tell you, this is one of those cases where the headline numbers really don't tell the full story.
Okay, so let's dive right in. Zymeworks served up what you'd call a classic mixed bag this quarter. On one hand, you've got the earnings per share, which came in at a loss of 26 cents. Now that was actually a solid 7-cent beat compared to what Wall Street was expecting. But on the other hand, the top-line revenue, well, that came in at $27.6 million, just a little bit shy of that $30 million mark everyone was looking for.
Now here's where it gets really interesting. Look at the market's reaction. Despite that nice bottom line beat, the stock sold off, and pretty hard, down 8% the very next day. So that left a lot of folks scratching their heads, asking the big question, what was the market really watching this quarter?
To figure out why that 8% drop happened, we've got to peel back the onion a bit. We have to look past those headline numbers and really get into the nuts and bolts of their financials to see what makes this company tick.
And this chart really tells the story perfectly. You see, their revenue isn't coming from some steady, predictable product sales. Not at all. The lion's share of it, a whopping $25 million, came from a single one-time milestone payment from their partner Johnson & Johnson. This just goes to show you how lumpy and event-driven their income is right now.
Now, on the other side of the ledger, you got to give management some credit. They showed some real discipline on expenses. R&D spending was actually down a little bit compared to last year, and their general and admin costs were basically flat. That's pretty impressive, especially when you consider they're pushing some key clinical programs forward at the same time.
And look, all that financial discipline leads to what is maybe the most important financial metric on the entire call, their cash runway. They are fully funded well into the second half of 2027. For a biotech company that's still in the development stage, having that much runway, that is a massive, massive strategic advantage.
So here's the crucial point, and if you take away one thing, this is it. The quarterly profit and loss statement, it's not the main event for Zymeworks, not even close. You have to think of it as just the engine that's fueling a much larger, much more important long-term strategy.
And here is that strategy, right here in a nutshell. We're calling it the royalty plus pipeline model. It's pretty smart. Step 1, they use cash from partners, like that big J&J milestone payment, to fund their own, wholly owned cancer drugs, their internal pipeline. And then, step 3, if there's anything left over, they give that excess capital right back to shareholders.
And talk is cheap, but their actions really show how much they believe in this model. They went out and spent nearly $23 million buying back their own stock, and they paid for it directly with that partner cash. I mean, talk about a vote of confidence from management, that they think their own stock is a bargain.
So, this brings us to the heart of the matter. If the quarterly accounting was really just background noise, what was the real signal the market was so laser-focused on?
The answer, of course, is in the pipeline. First up, Zymeworks dropped some incredibly encouraging early data for one of their homegrown drugs, ZW191. We're talking an overall response rate of 53%, and get this, 64% in some really tough-to-treat gynecological cancers, all with a good safety profile. This was a huge proof of concept for their entire drug development platform.
But believe it or not, even that fantastic data wasn't the main event. The market was holding its breath for something even bigger. This was the real catalyst that was going to define the entire quarter.
The entire institutional focus, the reason the stock was kind of weak after earnings, it was all about one single massive event on the horizon, the pivotal phase 3 data for their partnered drug, zanidatamab, which goes by the brand name Ziihera. This thing represents a potentially huge future royalty stream for the company.
And this timeline, man, it just tells the whole story, doesn't it? The stock drops 8% after earnings on November 7th. Then, just 10 days later, on the 17th, boom, the Ziihera data comes out, and it was a home run. Analysts were calling it a sweeping success, and the stock exploded up 29%. The market completely forgot about the Q3 accounting and voted overwhelmingly on the clinical data.
And that catalyst-driven win has led to some just massive outperformance. Over the past 3 months, Zymeworks has more than doubled the returns of the main biotech ETF, the XBI. You can see it right there. The strategy is paying off big time. So, with that major clinical question mark now erased and the Ziihera data officially de-risked, what's our take? Where does Zymeworks go from here? Let's really frame the investment thesis as it stands today, because honestly, the entire narrative for this company has fundamentally changed in just the last few weeks. The bull case now is just crystal clear. You've got a durable, long-term royalty stream from Ziihera that's now largely de-risked. That royalty money is going to fund a high-upside internal pipeline of their own drugs, a pipeline that just got validated by that great ZW191 data. And this is all sitting on top of a rock-solid balance sheet in a biotech sector that's finally starting to recover.
So here's the bottom line. The story here has evolved. This company has morphed from being a speculative platform play into a durable royalty franchise that also happens to have these really high upside assets that it owns completely. That is a powerful combination, and the market is really just starting to wake up to it.
So, given this fundamental shift in the story, we are initiating coverage with an outperform rating.
Looking ahead, we expect the stock to continue to trend higher. As that Ziihera royalty stream starts to become a more predictable, steady part of their revenue, we think the market is going to start to assign some real, concrete value to that now validated internal pipeline of drugs.
This is not financial advice.